down green.
Good evening, sir.
Good evening. Good evening. Okay, good evening, everybody. We'll start. So, till yesterday, we have completed the credit risk part of different exposure. 5 exposure we have completed, that is government, banks, corporate, retail, and NPA. And we have seen how the risk weight is assigned by RBI for each and everything. Okay. Now, those which we have discussed, all the 5 exposure, we have discussed about the fund-based exposure. Fund-based exposure. Fund-based means normally whatever the loans the bank gives to any borrower, whether it is CC, OD, or bills purchase, or bills discount, or term loan, demand loan, all these are funded exposure. But apart from funded exposure, bank also gives non-funded advances or non-funded loan like bank guarantee, LC, standby LC. Like this, so many things are also given by banks. So we will just look into the fact how these non-fund based exposures, for this exposure, what is the risk weight or how the calculation of capital or capital charge is to be calculated. Okay, now fund based we know. So risk weight of either fund based or non-fund based are same. Only what changes is the capital calculation formula. So if a corporate exposure is there where the rating is AAA, so what is the risk weight for this?
20%.
20%. So this corporate risk exposure, whether it is fund based or non-fund based, either it is fund based or non-fund based, if rating is AAA, irrespective of the fact that whether it is fund based or non-fund based, risk weight remains as per the assignment by RBI. It remains same. So if it is A, what is the risk weight?
50%.
50%. So same thing applies. Risk weight does not change for non-fund based. Risk weight will same. Suppose a bank guarantee is given for a central government, given to a central government exposure. What will be the risk weight?
0%.
0%. So it will not change. Whether it is a fund-based or not fund-based, risk weight will not change. What will change is the calculation of capital. So what is the formula I have told you for the capital calculation? What is the formula?
Exposure into risk weight.
Very good. So excellent. So this is the formula I have told you, that this will be the formula for funded exposure. Funded exposure. Because funded means already bank has given the money to the borrower. In the asset side, bank's asset side has increased by that amount. So fund has been taken away from bank, has been transferred to the borrower account. So in balance sheet, it is there. But non-fund based means there is no fund which has been transferred to the borrower as of now. So non-fund means only in the paper it is there. So it is not in the balance sheet. But in future, due to the default of the applicant or default of the, say, counterparty, this non-fund based may become fund based, because bank has to pay the bank guarantee. So while paying the bank guarantee, bank has to create a loan. So asset side, it will be debiting that amount. So it will become a fund based. Similarly, LC is devolved. The bank has to pay first. Later, it will be recovered from the applicant or borrower, whatever it may be. But first, bank has to create a loan account. So that means it becomes a fund base. So since non-fund based at present, it is not, any fund has not gone to the borrower. So that's why in future, if it becomes a fund based, then it becomes a risk for the bank. So risk will be credit risk or default risk, whatever it is. So for that purpose, RBI is told that we have to keep capital for the non-fund based also. Bank has to maintain the capital for non-fund based, but with a little bit of less amount of capital. So how this will be calculated? Simply same formula, another factor will be multiplied for non-fund based. That factor is called credit conversion factor, CCF. So like risk weight, a credit conversion factor has been assigned for non-fund based advances like bank guarantee, LC, or any bid bonds. So for this, RBI has assigned CCF. So that is also fixed. So like risk weight, a percentage is given as CCF. So normally what is the formula will be? Formula will be the exposure to be multiplied with CCF. So this will be the notional exposure for the non-fund based on which capital has to be calculated. Then risk weight has to be multiplied, CAR has to multiply. So additionally, one factor which is called credit conversion factor has to be multiplied for non-fund based advance. Clear? There is no doubt about it. Any doubt in this? No. Okay, fine.
No, sir.
So now, we'll see what is the credit conversion factor assigned by RBI. So in this slide I have given. So normally questions are asked on this type of instrument. So we are not going to other complicated instruments. Question will be coming for this type of instruments only. So as a first one says that it is a guarantee which is financial in nature. So bank guarantee can be two types. One is called financial guarantee, another is called performance guarantee. So if any guarantee or a standby LC is also a guarantee. It is not a clean LC. It is a standby LC, or it is not a clean letter of documentary credit. So standby LC are type of bank guarantee. When it is issued for overseas, any bank guarantee when it is issued overseas for overseas transaction, normally the term is used as standby LC. So any guarantee or standby LC which are serving as a financial guarantee, at that time CCF will be 100%. If a bond or guarantee or bid bond or indemnities or standby LCs which has been issued by the bank as performance guarantee, it is not a financial guarantee, it is against performance guarantee. In that case, CCF becomes 50%. If bank has issued a documentary LC, at that time, the CCF is least, that is 20%. Because documentary LCs are considered safest. This is safer and this is can be risky. So that's why, since these are risky, financial guarantees are risky, so 100% CCF is given. Performance guarantees or standby LCs or indemnities which are in performance guarantee in nature, they are little bit safer, so 50% CCF. And LC are most safest or safest one. So 20% CCF is applicable. So this much you have to remember. Like NPA, three things you have to remember: 150, 100, and 50. Like this, 100, 50, 20. Maybe in the question they will provide, but if you can remember, that is fine. So any type, any question comes for calculation of capital for off-balance exposure, so you can apply that formula. Capital is equal to exposure multiplied by CCF multiplied by risk weight multiplied by CAR. Or it can be represented as CCF multiplied by risk weight asset into CAR. Because we know exposure multiplied by risk weight is equal to RWA. Okay, there is no doubt about it.
Okay. So 1 second, sir.
What's the difference between financial guarantee and performance guarantee? What is meant by that? I don't know.
You don't know. Okay. Financial guarantees are given by the bank on account of any financial liability of the applicant. Financial liability. As I have explained to you, a bank guarantee issued to a applicant when he is supposed to pay monetary things to somebody against which the bank has issued the guarantee. So that is financial, purpose is financial. Okay, but performance guarantee, normally they are issued to the contractors. Contractors who actually builds some projects, like some contractors are given the project to construct dams or roads or some construction work which takes longer time. So in that case, what happens? Government assigns that thing to the contractor with the condition that we have to complete this within a certain period, say 3 years period. So his performance should be completed within a period of 3 years. Then only payment would be made by the government. In between, if he does not complete or he goes away or it extends the term period, then government says that no, it is not possible to make you payment. So for that reason, a bank guarantee is to be issued by the bank on behalf of the contractor to the government. So if he fails in his performance, then the guarantee will be invoked. Is it clear?
Yeah. Yes, sir.
Okay.
Thank you.
Okay.
Third
Anything
one
else?
also, so third one, letter of documentary.
Letter of document is LC. These are called LC. Your international banking classes has started, na?
No.
No, sir. No, sir.
Not yet started.
sir.
So letter of credits are the transaction which happens when import and export happens. Import-export happens. Import-export means, suppose importer is in India and exporter in USA. So they might be not knowing each other. So importer in India, X, wants to import something from Y who stays in USA. So Y is the exporter or Y is the seller, X is the buyer. So X says, I want to buy this much of things from you, kindly send it. So Y says, okay, I'll manufacture and send it. But what is the guarantee that you will make the payment? So in such cases, X will approach his bank in India, who will issue a LC on behalf of the importer. And LC will carry certain terms and conditions. And it will be sent to the banker of Y. It will be sent there. And Y will manufacture those things and he will send the goods to X in India. And as per the LC terms and conditions, he will fulfill all the conditions. So that means he has his invoice, everything, transport through shipping, all the insurance, everything will be checked there. Means he has fulfilled all the terms and conditions of the importer. So goods will be sent by ship, it will take some time. But when LC is say, so before this goods are shipped, LC will be sent to the banker of exporter. So they will receive, it will be given to the Y. Y, after shipping all the things, he will check all the terms and conditions raised by the importer, and he will check that yes, all the conditions is, and it will be sent back to the banker of X. When the bank receives the LC back with all the terms and conditions fulfilled by the seller, which would be before the reaching of the goods, immediately bank has to pay the money to the Y's bank. So money will be released by the bank. Whether goods have come or not, that doesn't matter, because it deals with the paper only, where LC is attached with a proof of everything. This much of material is that this is the material which has been inspected. These are the insurance. This ship contains this, and this ship will be living on this or has already left, and it will be reaching your port on this date. All the terms and conditions are fulfilled by Y with all the required documents proving that he has sent the goods. So once it is sent back to importer's bank, importer bank has to make the payment. You cannot stop it. So that transaction on which this is called, this is the most popular and safest and so widely used document for trade finance or import export thing, where it is called letter of credit. It is worldwide. It is governed by UCPDC. Uniform Customs and Practice of Documentary Credit. UCPDC 600 is the currently the law or entire thing is LC is governed by UCPDC throughout the world. So you cannot, this bank when gets the LC back from exporter with all terms and conditions fulfilled, they have to release the payment without checking anything. Only they have to check the LC, all the terms and conditions are satisfied, payment will be released. So the safest way of making payment to by the buyer to the seller, or by the importer to exporter. That is LC. Okay, so that is called LC. It will be, I think you might have in the JIB also documentary LC was a part of the subject in the foreign exchange. Little bit of things there, but here when you will be module A will be taught to you. At that time, documentary LC will be a very interesting and very important subject. Is it clear now?
Yes, sir.
Yes, sir.
Okay.
Yes,
So
sir.
we know that how to calculate capital for fund-based and non-fund-based advances with the formula. We know the formula. But here the credit risk does not complete. There are certain more things also available. So what is that? See, fund-based exposure or non-fund-based exposure, what is that? We'll first discuss about fund-based exposure. Now, two more adjustment has to be done for the exposure. So for the exposure needs further adjustment if at all it is there. Some terms and condition will be there. According to that, if those things are available, so some adjustment will be made to the exposure so that the correct amount of capital will be calculated. So what is that? Two things are to be considered. So one is called adjusted exposure. Second thing is called allowable reduction. These are the two adjustment has to be made. Okay, now I will explain what are the things. Okay, now first I will explain about adjusted exposure. What is adjusted exposure? First you understand that, then we will go to allowable reduction. How much reduction of the exposure can be done? Because exposure, suppose exposure is 100 and risk weight is say 50%, and capital adequacy ratio is 9%. How much capital is required? 4.50. Now, that means if exposure is 100, we have given a loan 100, we have to carry a capital of 4.50. Now, if there is a possibility that can we reduce this exposure or for some adjustment, is it going to increase? So for those adjustments, we have to ascertain what will be the correct amount of exposure according to certain things available in that loan. For that, these two adjustments are to be made. First adjustment is adjusted exposure. Okay, so basically adjusted exposure is what? First thing, I'll just tell you what. Okay, so adjusted exposure is when we are talking about loans and advances, loans or advances, we have two types of loans and advances, majorly two types of. One is type of loans or advances, or we can call them advances. Advances are which are running account in nature. They are running account in nature. Which are the advances which are in the running account nature? Can you give me example?
CC cash credit.
OD, CC, packing credit. These are all running account. Okay. And loans are either demand loan or term loan. These are, and definitely bills purchased, bills discounted. Only once disbursement is made, further running account is not there. So basically there are two types of account. Okay, and these two types of account, certain adjustment is required, because first we'll consider this CCOD. This capital calculation, normally it is to be done by the bank, normally done once in a year. Once in a year means after the financial year ends, next financial year starts. So as on the balance of 31st March 2022, we will take all the balance of the loans and advances and calculate the capital for the next year. Are you getting my point? So on this balance of March 2022, normally capital is calculated for a next year, and as and when it required in between also it can be calculated. But initially it has to be calculated on 1st of April on the balance of 31st March. Okay, so in this case, suppose 31st March, a CC limit was sanctioned to a borrower where the sanction limit is say 100. Okay, and drawing power is say 100 also. Now, the balance as on 31st March 2022, say it was say 60 only. It was 100, but he has not drawn fully, only 60 he has drawn, so 40 is undrawn. Is it possible or not? Any of the CC account that is a running account, possible that it might be 60. 60, that means what? On this balance, we are calculating the capital because 31st March is the balance we are taking. On 60, we are calculating capital. But this 40, which is undrawn, we are not calculating capital. Because this 40 can be withdrawn by the borrower on 1st of April or 2nd of April or any day after this date. So calculation of capital as 60 means we are underestimating the value. So the capital is not correctly done. So there is a possibility that the 40 may be withdrawn or it may not be withdrawn also. Are you getting the position? So all these CCOD or packing credit, same thing might happen. So for that purpose, RBI has said that one adjustment has to be made for such type of thing. If balance is 100, then there is no problem. Or 120, more than sanction limit, if the overrun, then there is no problem. Because we are at least keeping 100 or more than that capital which is required. We have covered the entire risk. But if we calculate on 60, which is lesser than the sanction limit, that means we are parting with some kind of risk. We are not taking care of this risk of 40. So for this purpose, always remember the rule of CCOD and packing credit. What is the rule? Rule says you have to take the exposure, whatever the balance is there. So 60 will be taken. 60 will be taken plus whatever the unrun portion. Normally CCOD, PC are sanctioned for a period of 1 year only. They are not sanctioned for a period of 3 years, 5 years, or 10 years. Because every year after sanctioning the limit, after completion of one year, again the limits are renewed or reviewed. Every year it has to be renewed or reviewed. So it is considered that CCOD, PC are sanctioned for a period of 1 year only. So the formula is whatever the debit balance as on the last date you have taken, that has to be taken, plus 20% of the unrun balance has to be added for calculating the capital. So here, what will be the amount? 20% of 20% of 40. So 60 plus 8. So instead of 60, we have to take the exposure as 68. So this is called adjusted exposure. Is it clear for CCOD or advances?
Yes, sir.
Any doubt? No doubt, no? So in the So in the question, if it comes that a borrower has been sanctioned a CC limit of 100 rupees, where the outstanding balance is 80 rupees, and the rating is AAA, if the CAR is 9%, calculate the capital. In such cases, this adjustment has to be made. So instead of 80, how much you will take? 80 plus
20.
1.6.
84 will be the exposure. 84 has to be taken. Clear? There is no
Sir,
doubt.
Sir,
Yes,
that
sir.
20% on undrawn balance is fixed. Actually, 20% that percentage is fixed.
Yes, yes. This is fixed. So it is called, normally 20% is fixed for CC as well as loan also. So that clause is called 20% of the underrun balance or undisbursed loans, which will be disbursed or which can be drawn within a period of 1 year, which I have not mentioned here because it is within a period of 1 year only. In term loan, there might be something which is more than 1 year also, that we will discuss. So this is fixed. 20% of the undrawn balance is fixed. Okay?
Okay, sir.
Okay, clear. Fine. Now we'll go to the term loan. Demand loan or term loan or any other thing. So in case of term loan, demand loan, what is the peculiarity is that, say, like CCOD, it is a running account, term loan is not a running account. Suppose a term loan has been sanctioned for rupees 500 crore. Okay, this has been sanctioned. When term loan is sanctioned, there might be a possibility that term loan disbursements of the term loans may be in phases. In phases. Suppose a big project loan is given for term loans, a big loan is like 500 crore. Even housing loan for construction of house or purchasing a flat also can be done in phases. At the beginning, some amount to be paid to builder. After 6 months, it will be paid. Then before completion or while you are moving in, the final amount is paid. So normally disbursements are in phases. So the phases means Suppose first disbursement has been made on say 1st of January 2022. Now, as per the terms and condition, second disbursement will be made say on 30th November 2022. Third disbursement will be made on say 4th of April 2023. And final disbursement will be made say in the month of say March, say 20th March 2024. So disbursement can be like this, which may take 2 years or more. In such cases, what will happen on 31st March 2022? Suppose you have disbursed 100 only. So on this balance you are taking, but sanction is 500. So as for this thing, another 100 to be sanctioned here, another 100 to be sanctioned here, and whatever the left is 200 to be sanctioned finally. So now what happens? These are undisbursed amount. These are yet to be disbursed. So if there is a approved terms and condition which has been sanctioned by the bank that these are the approved disbursement, phase-wise disbursement, in such cases, again adjustment has to be made. Is it clear? Like CCOD 20% adjustment, here also adjustment has to be made. Am I clear now?
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
Now, how this will be adjustment, how the adjustment will be made. So for term loan, whatever the first disbursement is made, whatever balance you are taking, so that exposure you are taking, that is the real loan balance. What on this date we are calculating, plus 20%, that same thing which is we have done in CC, same thing we'll have 20% of undisbursed amount to be disbursed within 1 year. Within 1 year from the first disbursement. Within 1 year from the date of first disbursement. So you have to add that 20% here. Plus 50% of the rest of disbursement. Means beyond 1 year, if anything is available, that has to be added as 50%. This is subject to the fact that all these conditions of phase-wise disbursements are as per the approved or confirmed sanction advice of the bank. Advice of the bank. Means bank has approved and confirmed. That means these amounts are going to be disbursed. If such things are not available, suppose the question says that there is no such thing approved and confirmed sanction advice, then this 50% clause will be not there. Only these two will be available like CCOD. Because since there is no sanction advice, this amount may not be disbursed. Okay, is it clear?
Sir.
Yes, sir.
Sir, once again, sir. Please.
What once again? Read it, na? I have written. What I have written here? I am not singing a song that you liked it and you say that please repeat, sir, again sing the song again. This I have written it. I have written. You read this, na? You read it. If you do not understand, I will explain again. You read it. What is written?
It is exposure plus 20% of the undisbursed amount to be disbursed in 1 year.
Within 1 year from the first disturbance. First disbursement is this date. First disbursement is this amount.
What is the LOC for it?
Huh?
LOC.
What is LOC?
Sorry, yeah, above EXP.
Huh? I don't get it. What is the LOC?
That's the loan amount.
Loan, sir, loan amount.
This is loan. Loan exposure, not LOC. Loan exposure. Like CCOD you have taken, na? So you are not listening. आप लोग focus नहीं करो. You are not focusing when I am explaining. Suppose term loan has been sanctioned for 500 crore. Okay. So today the balance is say 100 crore. You are taking this balance because outstanding balance as on say 2nd of April is this much. Okay. Now within a say 31st November 2022, another 100, say another 200 crore will be disbursed. Then say in the June 23, say 15 June 23, 100 crore will be disbursed. And say 20th of April 2024, another 100 crore will be disbursed. So that 500 is done. Now, what is the notional balance or adjusted balance we have to take? So the initial balance is 100. Initial balance is always there. So we have already disbursed this. That means 100 is to be taken plus how much? 20% of what? 20% of
200 crore.
200 plus 50% of
200.
200. So that, see, here you can check it. 200, 200 and 100. So it matches the sanction amount 500. It cannot be more than that. So what will be the balance? 100
240.
plus 40 plus 100. So you have to calculate capital on 240. Am I clear?
So just a question. Yes, sir. Hello.
Yes, sir.
Yeah.
Sir, this you said the 20% of the scheduled disbursement next 1 year from the closure, I mean from 31st March or from the date of disbursement of the first installment.
I told you, I have explained that 3 times that it is from
So that date will be given in the question, sir, when this was disbursed.
Yes, of course. Disbursement dates will be given so that otherwise how will you calculate all these things? 20%, 50%, unless the dates are given, how you will say that it is 20% and it is 50%?
Okay.
It will be given correctly. With date, everything will be given. Without date, how you will ascertain that within 1 year this will happen and this is more than 1 year happen? If dates are not given, how you will do it? And another, I told you, another condition will be there. This 50% condition will be applicable if the question contains the clause subject to that this disbursement schedule has been confirmed, is in the confirmed and approved sanction of the bank. Then only this to be taken. If that condition is not there, only this much you have to calculate. This has to be omitted. Okay?
Sir, if there is no condition given in the paper that if this condition is there in the sanction, then we will calculate on 200, 20% of 200, 20% of 400.
See, what is your question? Condition is there or not? You tell me. The condition of approved sanction is there or not?
No, there is no condition.
No condition means only this much you have to calculate. This has to be omitted. That's what I am repeating 2 or 3 times. I already repeated. Only this much has to be taken care of. 100 plus 20% of that. 50% thing will be not taken because if confirmed sanction is not there, bank may not disburse this thing. That is the logic. You please read this chapter in Macmillan book tonight only so that it will be clear to you. Okay, in Macmillan book, it is given clearly. You please go through that after I complete the session. Okay. Now, is it clear to everybody?
Yes, sir.
Yes, sir.
Yes, sir.
Okay,
Yes,
fine.
sir.
So this same thing.
Yes, sir.
So this is the thing we have adjusted exposure. Now we'll go to the second one. Second one was what? Allowable
Allowable reduction.
reduction. So what is that allowable reduction? Whether the exposure can be reduced further so that our capital will be less. So what is the purpose? Purpose is that every loan the bank gives, loan or advances bank gives, bank always takes some collateral security. Okay, that means this collateral security means to certain extent our loans are secured. That means risk has been reduced by obtaining collateral security. Is it clear? What I have told, is it understandable to all of you?
Yes, sir.
So that means suppose 100 rupees loan has been given and say some securities are taken, say we have our security value today is say 80. That means what? Our loan is secured up to 80 rupees. How much is risky?
20.
20.
Risky. So normally the portion which is risky, we have to maintain the capital, not the part which is secure. Okay, because loss will be this much only. Because we have security and we know that 80 rupees can be obtained if we sell the security. So 20 rupees will be lost. So for that, capital has to maintain. That is the logic. Okay. Is it clear? Am I clear for this?
Sir.
Yes, sir.
Yes, sir.
Okay, fine. Now, since securities are obtained, so those securities are of different types. Different types of securities are available, like cash, bank FD, NSC, LIC policy, gold, mutual fund, shares, or say any kind of government securities, bonds. So many things can be taken as collateral. So RBI calls it, they are called eligible financial collateral. RBI has introduced a term which are called eligible financial collateral. Means financial collateral. It has to be financial collateral like cash, bank FD, NSE, mutual fund, security like that. Okay, so basically this, and definitely after that we have land and building also, but they are not directly financial collateral. They are some other type of collateral, but they are not financial collateral. So RBI has given a list, complete list of eligible financial collateral, which can be reduced from the exposure. As I have reduced that 100 rupees loan, 80 rupees security. So 80 rupees we have reduced so that our exposure comes to 20 rupees. So for this purpose, a list is provided by RBI as risk weight and CCF. Eligible financial collateral list is here. And out of that, how much of that amount can be taken as a security and to be reduced, that is also given. So that is called, you might have heard about this, that is called haircut. That is called haircut. That means suppose very liquid securities are there, like cash, bank FDs, or gold, or say NSC of post office or LIC policy. They are liquid cash type of security. So in such cases, RBI says haircut is 0%. Haircut is 0% means haircut is nothing but either it is normally it is a depreciating value, depreciation, or sometime it can be also appreciation also. Sometime appreciation also, that I'll discuss later. When we are discussing about the collateral, So always haircut means depreciation. That means suppose you have obtained a fixed deposit for 80 rupees. That means haircut or depreciation or discount will be 0%. That means full value of 80 will be taken into consideration for reduction. So this allowable reduction will be 80 rupees only. Suppose for some security, some bonds have been obtained by a security where the haircut is assigned as say 10%. So bond value is say 500. So how much will be allowable reduction?
50 rupees.
Allowable reduction. How much this allowable reduction is? The
450.
amount which will be reduced.
450.
450. So you have to discount with 10%. 450 will be eligible to be reduced from the exposure.
So 450 is the haircut.
Array, haircut 10% here I have written, haircut here I have given arrow. 10% is the haircut, means depreciation.
वो नहीं देख रहे हैं
500 with 10% depreciation means 450. Are you looking at the screen or not?
Yes, sir.
Then I have given a arrow here. Haircut 0%. Then I have given an arrow 10% haircut. I told depreciation. I told. So how 450 will be debited? 450 is the depreciated value after depreciation is deducted from the original collateral. Is it clear now? Everybody is clear?
Yes, sir.
Yes, sir.
So suppose a security value is say 500 and haircut applicable is say 6%. Now tell me what is the amount of eligible financial collateral to be reduced from the exposure?
470.
470.
30 rupees.
Or
470.
very good. Suppose exposure is 1000 rupees. What will be the adjusted exposure?
530.
So 530 will be the adjusted exposure which will be taken for calculation of capital. Is it okay? So this is called adjusted exposure, or we can call it net exposure. Net exposure after adjustment of those two things. So net exposure, what is the net exposure we have to take for calculation of capital? Net exposure is equal to exposure with adjustment of that 20% and 50% thing. First adjustment of this plus this reduction. After that, we have to adjust that thing. So first we have to see this one. Suppose exposure was 100. Now at adjustment of this 20%, everything we have done. So we can add that. Suppose it comes to say 20. So now net exposure 120. After that, this suppose security available is said 150 and haircut is said 10%. So haircut is say 20%. So how much is the security we can reduce?
130. 120.
120. So from here we have to reduce 120 means 0. So no capital will be calculated. So there is no need of calculation of capital for this since exposure becomes 0. Okay, is it clear?
Yes, sir.
Yes, sir.
Any confusion you ask me. If at all I'm going to next slide, I will not explain. Please ask me. So I have told you two steps to be followed. First one, CCOD or term loan, where that 20% adjustment and 50% adjustment has to be done. So basically this is to be added with the original exposure, if at all these are there. After that, this eligible financial collateral has to be deducted after haircut. Is it clear? So exposure 100, suppose this has come to 20, and suppose after haircut, so this is plus. After haircut, suppose it comes to 50. So what will be the total? It will be 70. So 70 will be taken as a exposure for calculation of capital. Is it okay?
Yes, sir.
So if you understood, then another thing has to be mentioned here. Another thing I am to explain, please focus on that. Now, there are two more things which has to be again, you have to calculate. So it is not so simple. Risk management is not so simple. So remember, after arriving at this net exposure for calculation of capital, two more things are there. So first one again, or we can call this third one, third adjustment. So it is possible that the loan has been disbursed in a currency. Say it is disbursed in rupees to the borrower. But the collateral which has been obtained, which is the EFC, eligible financial collateral obtained, it is not in the rupee form. Suppose that is in US dollar. Or it can be reverse also. Loan is given as US dollar, but collateral is in Indian rupee. That is also possible. So when both loan and collateral in same currency, we call it there is no mismatch in currency. If they are same currency, both loan and collaterals are on same currency, there is no mismatch. So no mismatch means no adjustment. But when there is a mismatch, means loan is in rupee, collateral in dollar, or loan is dollar, collateral in rupee. So here there is a mismatch. Mismatch of what? Mismatch of currency. If there is a mismatch of currency, then with this net exposure, we have to multiply a constant factor. That is 8% has to be multiplied. Or we can multiply 0.08. 8% equal to 0.08. So if there is a currency mismatch, then 0.08 has to be multiplied. So our calculation of capital will be the exposure, whatever the net exposure comes, multiplied by this. This is called FX, or we can call it HFX. Haircut for currency mismatch. It is called HFX. So we have to multiply that. Then we have to multiply risk weight. We have to multiply CAR to get the capital. Are you okay with this?
Yes, sir.
Here, 8% is the constant. It is constant. If there is a currency mismatch, 8% has to be multiplied. That's all. Okay? Is it okay?
Yes, sir.
Now, fourth thing. Loan has been given for a period of 3 years. Suppose a term loan is given for a period of 3 years. Collateral which is obtained, that is available for 2 years. Again, there is a mismatch of tenure or time period mismatch is there. If both are same period, then there is no mismatch. If they are different, then it is considered normally difference in the sense that collateral is available for a shorter period than the loan. If loan is 2 years, collateral is 3 years, then there is no risk at all. So if the collateral is available for a shorter period than the loan, then we'll consider that there is a mismatch of tenure. In such mismatch, another factor has to be multiplied. So that is called maturity factor. That maturity factor I will describe when I am going to do a numerical. Till this point, am I clear?
Yes, sir.
Only one yes I heard. There are 100 people.
Yes, sir. Yes, sir.
Yes, sir.
So if I do a numerical, it will be clear to you. Okay. So for that, the formula I will tell you. So formula is how. So this allowable reduction formula for haircut formula, I'm going to explain that. So basically the formula is like this. You can do with a complete formula. This is the complete formula. If you can do that, that is fine. Otherwise, I can simplify that one. So I am writing this formula for you. The formula is, see, you go with this formula. Okay. So for bank and bank fixed deposit, NSC cash, since they have zero haircut, so normally this formula is simplified as this one. So we will not consider that. We can use this formula for zero haircut also. Okay. So now I will just explain that the formula is C. This is our net exposure. Net exposure equal to C multiplied by 1. I will just explain the abbreviation. 1 minus HC minus HFX. Okay. 1 minus HC minus HFX. Then what was that? Okay. Into multiplied factor into, okay. So net exposure equal to C multiplied by 1 minus HC minus HFX multiplied by maturity factor minus E
Into HC.
E plus HC. Okay, that I will explain later. Okay, so you forget about this right now. That is separately, and we will do this one. This is for adjustment of that thing. Okay, now net exposure equal to C means this is the collateral value, whatever collateral value you are having. So C is the EFC value. C is the EFC value of eligible collateral available. HC is, this is HE. Okay, so HC is haircut of collateral. Haircut, H is haircut, C is collateral. Okay, now HFX is that 8%, which is for what? HFX is 8% is for what?
Currency mismatch.
Currency
Very
mismatch.
good. Currency mismatch. Okay, now I have told you MF maturity factor is for what?
Turnover mismatch.
Tenure mismatch or tenor mismatch, whatever, same thing. Tenor mismatch or tenure mismatch. This is maturity factor. Now E is the exposure. What is the exposure? Okay, and HE is the haircut for exposure. Haircut for exposure. So normally when this thing will come, you will see that here haircut is added to the exposure, but haircut is deducted from the collateral. Okay, so this type of question I will discuss later. So for time being, we will be not considering this one. Okay, so now everything is clear except the maturity factor. What is this maturity factor? Maturity factor is also a constant thing like HFX. So that formula is small t minus 25% divided by capital T minus 25%. Or we can say T minus 0.25, capital T minus 0.25, where small t equal to the tenure of collateral or EFC, eligible financial collateral. Capital T is the tenure of exposure. Is it clear? Tenure of the exposure means loan given for how, loan is given for how much period and collateral available for how much period. So we will take into case, normally question will come where the tenure of exposure will be always more than the tenure of the collateral. Then only it becomes a risky factor. At that time, this thing will come into picture. So you have to multiply this maturity factor as this one, T minus 0.25 by T, capital T minus 0.25. This is a constant formula. You have to apply that one. Okay? Clear? Can I proceed?
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
Now, first problem I will do. So here the problem will be like this. What is written here? Exposure of 500 is secured with financial collateral of A plus debt security of 150 issued by others with haircut of 6%. The tenure of exposure is 3 years and the residual maturity of the financial collateral is 2 years. Okay. Find the haircut adjusted value of the collateral, then find the net exposure, and finally find the value of exposure. This I have not described. This I will do when I complete these two things. Okay, so simple thing here. Is there any currency mismatch?
No.
No, sir.
No,
sir.
because loan is also rupees, security is also rupees. So there is no currency mismatch. When currency mismatch is not there, HFX will be 0. So HFX will not to be taken into account simply. If there is a currency mismatch, then only we will take 8%. Otherwise, we can just omit that one. Okay. Now, exposure is how much? 500. Collateral is 150. Haircut for collateral is
6%.
6% means 0.06. What 9?
9.
So tenure of exposure is
3 years.
tenure of collateral is
2 years.
so we can apply the formula. First formula we can apply, which is called the first we have to find what is the haircut adjusted value of the collateral. So that I can take as C asterisk. This is the haircut adjusted value of the collateral equal to C multiplied by 1 minus haircut minus HFX multiplied by maturity factor. So I will replace the value. C is how much?
500.
C is how much?
150.
150.
150. Multiplied by 1 minus HC
Minus
is how much?
0.06. 0.06.
HFX is how much?
0.
Maturity factor, how I will write?
T minus
2 minus 0.25
5 divided by
2 minus
divided by 3 minus 0.25.
Correct. Very nice. Excellent. So now I can get it. So 150 multiplied by how much this will be? 0.94. Multiplied by 1.75 divided by 2.75. Now you tell me how much the answer is coming.
89.72.
89.72.
89.7.
Okay, so this is what? What is this 89.72?
Haircut adjusted value of collateral.
Very good.
Adjusted
So
value.
this is the haircut adjusted value. Now, what is the net exposure will be? Net exposure will be exposure minus C asterisk. So exposure is how much?
500.
500 minus
Minus 89.72.
So how much it will be?
410.27.
28 or 27, whatever. So 427 is the net exposure which will be taken for calculation of capital. Okay, clear? There is no problem in this?
No.
Okay, fine. Now they may ask, sometimes this is also asked, what is the value of exposure at risk? So this value of exposure at risk is a little bit confusing. The formula is, so value of exposure at risk. So exposure at risk. So this we call VE at R. So is equal to value of the collateral, original value of the collateral minus the haircut adjusted value of the collateral. So how much it will be?
150 minus 89.7.
60.28.
60.28 will be the answer for value of exposure at risk, because this much of amount we have reduced from the exposure, and the rest amount is not able to be reduced. So this is the risky part remaining. So that is called value of exposure at risk. So remaining part of the collateral which could not be adjusted because of the haircut as well as other mismatch problem. So that is the value of exposure at risk. Clear? Am I clear with this problem?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Now you do this problem. You do yourself, I will assist you. Exposure is
$500 million.
500 million.
Currency mismatch is there.
Collateral is 200 million rupees.
200.
So this is 200 million rupees.
HC 4.04.
0.04. Tenure of exposure is 3 years and collateral is also 3 years.
So there is no tenure mismatch.
Mismatch. There is a currency mismatch.
Only currency mismatch will be there. So HFX is equal to
8%.
0.08. Now here, yeah. Here another thing is missing in the question. I have not given. So exposure is given in dollar. So I have missed one thing. You can write dollar equal to say 75 rupees. Say 75, or now the dollar is more than that. So you can take 80 rupees. So $1 equal to rupees 80 you take.
40,000.
So you first calculate what is the haircut adjusted value of collateral.
Adjusted value of collateral.
You convert this to rupees because this is rupees, so you can convert this to rupee.
40,000.
40,000 what? Rupees.
Rupees.
This is in million.
Sir,
40,000 million.
40,000 million.
Okay. So 40,000 million. 40,000 million rupee, and here it is 200 million only.
Sir.
Yes, I'm listening.
We can calculate this. HFX.
I can't hear you. Your voice is breaking. Your voice is breaking.
Haircut adjusted value is 176.
Haircut adjusted value is how much?
HFX, how we are calculating?
176.
How are we calculating HFX?
176 million rupee, right?
Yes, sir.
Okay. Okay.
Yes, sir.
Okay. So everybody is getting that answer?
Yes, sir.
Yes,
Net
sir.
exposure is 39,824.
Yes, sir.
So simply you have to minus that 176, right?
Yeah, 39824.
So what is the value of exposure at risk? Value of the exposure at risk will be how much? 24. So this will be 24. Okay. Anybody having any problem with this one?
No, sir. No, sir.
Somebody was asking some question. I could not hear. His voice was breaking. HFX is not
Sir,
as calculated. HFX is a fixed material. 8% is the fixed. Silpa, you are Silpa, right?
Okay, sir.
It is
Yes, sir.
8%.
Yes, sir.
8%
There is
is
mismatch in currency.
Okay.
there is no mismatch in currency, na?
Okay.
Yeah. This is the mismatch in currency.
Mismatch in
But
currency, sir. So 8%.
HFX
Otherwise,
is mismatch.
0%.
Otherwise, 0%. Yes.
Value of exposure
Okay,
at
sir.
risk.
Understood.
Clear? There is no issue with the problem.
Understood, sir.
No,
Third
sir.
one, sir.
Yes.
Value
Clear,
of
sir.
exposure
Clear.
at risk.
200 minus 176.
Value of exposure at risk, I told you, na? Original
200
collateral minus adjusted collateral. This is the value of exposure at risk.
200 minus 170.
All answer will be in rupees.
Sir, answer for net exposure.
Answer for
40,000 minus 176.
Net exposure.
net exposure. You calculate. I have
39824.
I have written here, na?
39824.
Okay. Okay, sir.
I think I should have made. I think 5 million would be adequate. It is becoming very big. 5 million would have been 400 million. Okay. Anyway, leave it. So you have done it. There is no problem. Okay. Clear?
Yes, sir.
Such type of problem will be coming. I have given both the thing with tenure mismatch, with haircut mismatch. I have given, so you can do the problem, as well as the currency mismatch of also we have done. All the possibility we have done, so you can easily do. Okay. Only thing what is I have not done is that sometimes what happens, sometimes the question will be asked where bank has given a loan by borrowing from other party, which is borrowed cash from other bank in the credit market. So in that case, what happens? In such cases, the exposure also will have a haircut. Exposure is also given a haircut. So here it's like this: exposure of 500 million with haircut of say 2%. So that time HE will be given. So in such cases, you always remember haircut to the exposure is always added. Exposure will go up, collateral will come down due to haircut. So here 500 million is the thing. So 500 million, 2% will be added, means 102% will be the value of haircut adjusted exposure. If 2% is the haircut value of the exposure, that means it becomes exposure multiplied by 102%. So how much it will be? 102% will be how much? 510. Or you can add just 500 plus 2% of 500. So that means 102% only. This is 100 and 2%. So 102 I have taken. Okay. So if there is a haircut for exposure, that is denoted by the HE. HC is the haircut for collateral. HFX is the, what is HFX?
Haircut of currency.
Currency mismatch.
Currency mismatch.
For currency mismatch.
MF is denoted by MF is correct. Very good. Very good. So you have done the problem. There will be no problem at all for you. Okay. Now we'll move to the next thing, which is called the expected loss. So how the expected loss can be calculated with a different way, which is a probability method, or we can say it is a other method of calculating the expected loss. How these are calculated? Sometimes questions are coming for that. So MCQs will come. So you have to be careful. Sometimes one numerical might also come. So just listen carefully. If they won't give you any haircut, if haircut problem is not given, then fine, nah, this question will not come. If haircut is not given, somebody is asking if they will not giving a haircut. If it is not coming, the question will not come, because this problem is based on haircut only. Okay. If haircut is not given, then how you will do the problem? For eligible financial collateral, always haircut is to be given. Okay. Now, expected loss, how it will be calculated? What is again? If there is no mismatch in tenor, we have to take yes. If there is no mismatch, don't take MF. Either you take MF as 1 or don't take MF. Don't multiply NF, because there is no MF at all. You cannot take 0. Multiplying 0 means everything will be 0. So either multiply with 1 or just omit MF if there is no tenor mismatch. Don't take MF. The formula is C multiplied by 1 minus SC minus HFX multiplied by MF. So if currency mismatch is not there, either take MF as 1 or don't write at all. Just leave it. Similarly, if HF currency mismatch is not there, you can omit simply. Without taking 0, you can omit. So formula will be 1 minus C into 1 minus HC. That will be the formula. Clear? Now we're moving to function of expected loss. So expected loss calculation are given through a formula, or which with a function of 3 different things, which are called, one function is called probability of default. What is the probability that this loan or this investment might be defaulted? So can you please mute your mics, please? Again, some sounds are coming, please. Suvasini, please mute your mic. Okay. So first we have to see what is probability of default. Probability default is a measure to find out the likelihood that the borrower will default on a loan repayment over a given time horizon. So that means it is a measure to find out that how much there is a probability that within this period of time borrower may default. So that PD can be given within a range of percentage, which can be 0% to 100% also. 0% means totally it will not going to default. Borrower will never default. 100% means it is going to default. This range of percentage depends on various factors regarding the borrower, like credit history of the borrower, economic condition of the country, how the industry in which the borrower is working or doing the business, how is that market, performance of that industry. So much things are there where PD has to be just ascertained by the bank, and it can be given a percentage according to the history of the borrower, credit worthiness of borrower, economic condition of the country, market performance or market of the business where the borrower is doing the business. So according to that, PD can be given as a percentage. Next one is called loss given default. That means it will give a it will measure the proportion of the exposure that will be lost if the borrower defaults. That is, it is the loss amount after adjustment of any collateral which is available and which can be recovered from the borrower at the time of default. Are you getting me? Suppose 100 rupees was loan given and collateral available is 60. So we can adjust this collateral. So what will be loss given default? Loss given default will be 40 only. And this can be expressed as a percentage also. So both are given as percentage. This is the probability of default and this is the amount of default after adjustment of all the collateral available or other things which is recoverable from the borrower. Third thing is called exposure at default. It means the amount of facility that is likely to be drawn in the event of the default. That is amount of loan outstanding at the time of default. So this is the exposure at default. So we can call that PD, LGD, and EAD. These are the three things which I have explained. Okay. Now the expected loss formula is exposure at default multiplied by PD, probability of default multiplied by LGD. This is the formula. Okay. Now I'll just explain one thing which is important for that. So how this how this LGD is to be calculated, because we know PD has to be calculated by the bank. Suppose I am giving an example how this loss given default will be arrived at. Suppose a loan has been disbursed for a, say 50 lakh loan has been disbursed. This is a loan amount or exposure this one. And collateral security available is say 20 lakh. So this is 20 lakh is the collateral security available. Now LGD is calculated as 1 minus a recovery rate. 1 minus recovery rate. So what is this recovery rate? A recovery rate is the percentage of the amount recoverable at the time of default after adjustment of the securities. So what is the recovery rate will be? So recovery rate percentage we want. So 20 lakh is recoverable because collateral security available. 20 lakh is recoverable from a loan of 50 lakh. So we can take it as a percentage. So this becomes how much?
40%.
So this becomes 40%.
40.
40%. So 40%, or we can say this is 0.40. So LGD will be how much? LGD will be 1 minus 0.40. So equal to 0.60, or we can say this is 60%.
Sir, how the recovery rate is calculated? Recovery percentage amount recovered at the time of default.
The collateral security.
Here I have written this 20 rupees is the collateral security divided by loan amount into 100. Here I have written percentage amount recoverable at the time of default from the loan. When I am explaining, you are definitely absent, or you are absent-minded, you are looking at something else. I have written here, then I have written everything when I was telling 20 rupees is the collateral, 20 lakh is the collateral, 50 is the loan amount. I am converting into percentage. So 40% is 0.40. So LGD becomes this much. Suppose LGD here is 0.60. Suppose probable default is given as 40% or 0.40. Then what is the expected loss? Can you calculate and tell me what is the expected loss? I have given you the formula also. Expected loss formula was how much?
0.32.
Point? How?
32.
How?
0.24.
0.24, sir.
How? Sir. How?
LGD into PD into
LGD into PD.
What is the formula of EL? Expected loss formula, I told that
LGD into
EAD into PD into LGD.
so how much? Then EAD is how much?
We don't know.
How you don't know?
30 lakh.
Exposure at default is 50 only, na? Out of which this LGD will be the
12, sir.
12.
Answer.
into PD is 40%.
40%.
So how much? 12. Okay.
12.
So 12 lakh will be the answer. Okay. Is it okay with you?
Yes, sir.
Okay, fine.
This
Now,
probability of default will be automatically given, sir, from all the
yeah.
exposures. We have to calculate.
In the question, PD will be given. Normally, it is given by the bank. So, question will contain PD, but and exposure at default, that will be there as loan amount, and security amount will be given. You have to calculate the LGD. LGD formula, I told you, 1 minus recovery rate. A recovery rate also I told you, percentage amount recoverable at the time of default out of the total exposure. So security, collateral security divided by the exposure multiplied 100 is the recovery rate. So whatever percentage comes, 1 minus that percent becomes LGD. Exposure at default means that amount of loan which is given, that might be the exposure. When you multiply to LGD means that much will be at loss. Then PD is probability of time. So that will give us total expected loss for this loan. So out of 50 lakh, we are going to lose 12 lakh as per that calculation. 12 lakh is sure that we are going to lose. Other things are not possible because we are recovering how much? 40% is recovered, right? 40% is recovered. 40% means how much?
20 lakhs.
20, 40% of 50 is 20. 20 is recoverable, but loan is 50. But why it has become 12? Because the probability of default is 40%. If probability of default becomes 100%, then we are going to lose entire 30 rupees because 20 rupees is recoverable, 30 cannot be recovered. Because the probability default is less than 100, that's why our loss will be less. So 12 lakh will be the loss.
Here, HC will not come into play, na, sir. In this case, collateral HC haircut.
That HC movie is over.
Now we are taking 20 lakhs as collateral. In this haircut also, if they have given, then
no. Haircut is applicable for calculation of capital, not for the loss.
Okay.
That's why I told you that movie is ended. This is a new movie. Expected loss is new movie. Capital calculation was old movie. That is separate movie. This is separate movie.
Please show the example you gave just before.
Pardon?
The example you gave about the function of expected loss, in which we find the total 12 lakh loss. Please show the screen, sir.
No, I have erased that one. What is your question? I have erased that one. There is nothing is there. I have erased. What you want?
Nothing. आगे बढ़ाओ ना यार.
See, always he repeats the thing. Why? I don't know. I think you are absent-minded when I am explaining. You are not focusing on this. That is not good. Every time you ask me to repeat, I am not singing a song. So just I will explain about operational risk little bit. Then we'll end today's class. Next class, I will start with how to calculate operational risk capital and market risk capital. Then our risk management will be over. So operational risk, we know the risk which brings loss to the
Loss
bank
resulting from
you can read.
So
Either I
somebody
will read or
speaking.
you can.
Somebody
Either
speaking behind.
yeah, that's why telling if I allow me to read or you read. If you want to read, I will stop. No issue. Otherwise, you can read in mind. Silence, you can read. The risk which brings in loss resulting from inadequate or failed internal processes or internal system due to people failure or system failure, or it is done by people, or from the impact of external events which are not under our control. So they are to be under operational risk. Okay. So basically, scope of operational risk is very wide. Anything can happen. You cannot expect those things. You cannot calculate. You cannot estimate. You cannot assess the loss. How much it will happen, when it will happen, how it will happen. So there is no way to determine how much it will be happen. So for that reason, the capital calculation is totally different. Here there is no asset involved where we can give a risk weight. So for this purpose, Basel has done recommended what? Operational risk, since we do not know, so we can assume one thing. So they have told that first method is, what is the first approach of operational risk? Calculation of calculation. Very good. Basic indicator approach. BIA. Basic indicator approach. Second method is
Advanced measurement.
standardized method.
Standardized method. Third one.
Third is advanced measurement. Third is advanced. So this we'll discuss later. So basically, two methods are there where India is currently doing this. So basic indicator method or basic indicator approach and standardized approach. These two are there. Okay. Now for these two things, what Basel has suggested that since it cannot be assessed estimated, so we will take only the gross income of the bank for the last 3 years. Last 3 years gross income means, this you understand, gross income of 3 years to be taken and gross income of 3 consecutive years or 3 consecutive years when the profit is there. Because gross income of the bank, when bank has earned profit for that year's gross income has to be taken. That means suppose 2022, 21, 20, 19, 18. So these are the years. Okay. Now all these years, suppose here there is a profit, here also profit, here there is a loss, here there is a loss, and here there is a profit. That means 3 consecutive profit years gross income has to be taken. So you have to start with this. So this will be taken, this will be taken. Here negative, we have to omit this one. Here negative, you have to omit this one. Next, this will be taken. So 3 consecutive profits years gross income has to be taken. And those gross income, 3 years gross income divided by 3 means average of 3 years gross income has to be taken to be multiplied with a factor called alpha under basic indicator approach. And for standardized approach, the same thing, average of 3 years gross income. So gross income divided by 3 multiplied by beta. So here alpha is 15%. But here beta is 3 types. One is 12%, one is 15%, one is 18%.
18%.
12, 15, 18. And for that, the gross income is also has been divided into, in standard approach, gross income has to be calculated for 8 different business lines. So entire bank's business has been categorized under 8 business lines, where for each business line, either 12% or 15%, 18% has been given. So whatever business line is applicable, you take the gross income for that, for last 3 years average, multiply by the applicable beta and find the capital. So this is the process of calculating capital. Have I confused you more, or it is simple?
Simple only, sir.
Simple only, na? So you are only
Yes, sir.
telling simple. What about other people?
Yes, sir, clear.
Clear, na? First, you understand the formula is average of 3 years gross income
Income.
multiplied by alpha.
Alpha.
So first we understand this basic indicator approach, then we'll go to the second one. So here, what is gross income? How the gross income will be calculated? Normally at the year end, what happens? You have profit and loss, as well as you can have your balance sheet. Normally in the balance sheet, we have net profit.
Yes.
Right? Net profit is figure. So P&L you can find all the things, but balance sheet is available where net profit is there.
Net profit given.
So net profit, to reach gross income, we have to go backwards. Net profit to gross income. Because from gross income, lot of things has been deducted, so that we have arrived at the net profit. So we have to move back to reach at the gross income. It is like your net salary and you have a gross salary. So if net salary is known to you and other factors are known to you, which have been deducted or added, whatever it means, so you can go back with adding or deducting those things to get the gross salary. Yes or no?
Yes, sir.
So this is the process how the gross income will be arrived at. Certain adjustments to be made. So in the questions, they will give the figures and you have to adjust those things as plus or minus. So I am giving the formula. I'm giving the formula. So gross income, actually gross income is nothing but net interest income and net non-interest income. But if the questions are given, you have to calculate all things. So question will contain all the things. So you have to do plus and minus. So if net profit is given and other things are given, so provision and contingency figure to be added, operating expenses to be added, profit on sale of HTM investments to be deducted, loss on sale of HTM investment to be added, any insurance income from any insurance, whether you are getting insurance claim or insurance fee you have received by selling insurance, those to be deducted, and any other extraordinary or irregular income which are available, that to be deducted. So basically these two deductions, income of insurance, extraordinary or irregular income, means they are not the income from our core banking business. Like extraordinary irregular income, that means suppose some of the legal fees or legal fees recovered from the borrower. So that is not a regular income of the bank. So that will be deducted. Suppose something has been sold, say newspaper or some say fixed asset has been sold and you have received some money. So that is not a regular income. So they become extraordinary income. So those are to be deducted. So you have to remember this formula, because question will come under this heads only. So to arrive at gross income, you have to add provision and contingency and operating expenses with net profit, then deduct the profit on sale of HTM, add the loss on sale of HTM investment, then deduct income from insurance and deduct extraordinary or irregular income so that you get gross income. So 3 years gross income you have to arrive at, then make the average, multiply by how much? Alpha is how much?
15%.
15%. So that becomes your capital. Capital for operational risk under basic indicator approach. Okay?
Yes, sir.
For standardized approach, same thing, but here the different thing is that for each business line, there are 8 business lines. So in question, all the business line will be given. And for this business line, you have to calculate the gross income, average gross income for 3 years. So 3 years figure will be given and you have to calculate the average. And according to that, the different betas are given like this. So these are the 3 business lines where 12% is the beta. These 2 business line attracts 50% beta and these 3 attracts 18%. So all the 3 things will be given in the question. So you have to just multiply those things as applicable and total is the sum of all the things. But if basic indicator approach is given, this alpha is 15%. Sometimes they will, in the question, they will not give this one. So you have to remember alpha as 15%.
15%.
Okay. So this today we will close with this one. Tomorrow I'll give little bit of about discussion about advanced measurement approach for capital charge of operational risk, which is not actually applied in India, but in syllabus it is there. So you have to know how this is calculated. So tomorrow we'll discuss that thing and we'll go to market risk and our risk management will be completed tomorrow. Okay.
Okay, sir. Thank you, sir.
Any other question is there? You can ask me. Still 5 minutes is there. I can.
Sir, international banking also you take, sir?
No. Sorry. I am only assigned for CIB only these 2, and sometimes I 3 things I take. Risk management, balance sheet management, as well as the retail banking also I take.
Okay. Sir, is there class tomorrow, sir? Or 2nd October?
I have to check. I don't know. Tomorrow morning class is there. Just I'll see.
Evening
check.
class, no, I think, sir.
Tomorrow is 30th, na?
Yes, sir.
Yes, sir.
No.
Sunday.
Evening. Tomorrow is Friday, na? Friday no class. In the evening there is no class. Friday is not there. Saturday is not there. Sunday is not there. Monday we have evening class. Monday we'll resume the class. Okay. That Monday we'll complete risk management as per the schedule. Then 6th, 10th, 11th, 12th, 13th, our balance sheet classes will be there. Okay. Balance sheet management.
Sir, you will be taking the balance sheet management class.
Monday,
Are you interested that I will take or somebody else will take?
Yes, sir.
You will take, sir.
You, sir.
Sir, you
Take,
take,
sir.
sir.
So, okay, on public demand. If you don't want me, then you can ask IPS that.
No, not like
Sir,
that, sir.
90% people select you, sir.
Okay, then I will take.
Okay,
Then definitely I will take. Okay. And
Thank
I
you,
will
sir.
try to see normally what is, I'll just discuss one thing, just 1 minute. Okay, just 1 minute. See, normally for completing risk management plus balance sheet management, IBS gives me 18 hours. Okay, 18-hour class is there. So basically, we are running as per the schedule. So basically, I can take 9 hours. Within 9 hours, it has to be completed. So till now, we have completed 7.5 hours. So my schedule is that next class we will be completing risk management. Now rest, whatever thing is given as per schedule, I will try to complete. But I also want to normally for each session, each season, after the risk management class and BSM class is done, theoretical part when I do, I also take 3 hours class, risk management 1.5 hour and a half hour, where I do around 20 to 30 numericals problems only.
Okay, sir.
Only. So I will try to, if 3 hours is available, then we'll do it. Otherwise, I have to request IBS that extra 3 hours is needed. So normally what happens, actually, suppose I would have completed today within 7 hours. If I would have completed this risk management, then within the scheduled time I would have taken those numerical. But I think there will be a shortage of time. So I will request IBS. I think they will be definitely allow it. Let's see how it goes. So because if I discuss at least 50 questions, say 30, 60 questions, if I can discuss, which are important, so that it will benefit for you, because you can easily score marks in the examination. Because I know lot of people, say around 20 to 30 people, they have scored more than 65 in BFM because of numerical. Last time somebody has scored 79, 81. The highest score was 81. 81, 79, 80. 4 or 5 people have scored more than 75 because of numerical. We'll try that. Okay. See you in the next class.
Okay, thank you, sir.
Okay, sir. Thank you. Thank you, sir. Good
Thank you,
night,
sir.
Thank you, sir.
Okay. Okay.
Good night, sir.
Good night.